Good morning, gentlemen. Welcome back to BUS 325 Investment Course. This is your instructor, Mohammed Al Jaber, and today we're looking at Chapter 4. By the end of today's lecture, you are expected to be able to cite the advantages and disadvantages of investing with an investment company rather than buying securities directly. Contrast open-end mutual funds with closed-end funds, unit investment trusts, hedge funds, and exchange-traded funds or ETFs. You're also expected to be able to define net asset value and measure the rate of return on a mutual fund. You should be able to classify mutual funds according to investment style. And finally, you should be able to demonstrate the impact of expenses and turnover on mutual fund investment performance. So let's get started. Let us begin today's lecture by first trying to understand what an investment company is. Investment companies are financial intermediaries that invest the funds of individual investors in securities or other assets. Investment companies perform several important functions for their investors. The main four functions that investment companies provide are: first, record keeping and administration. So basically, the investment company issue periodic status reports, keeping track of capital gains, distributions, dividends, investments, and redemptions, and they may reinvest dividends and interest income for the shareholder. So an automatic or automated dividend reinvestment plan. The second benefit is diversification and divisibility. So by pooling their money, investment companies enable investors to hold fractional shares of many different securities. They can act as large investors even if any individual shareholder cannot. Not all investment companies offer this functionality or this feature, but most of them do. The third benefit is professional management. So the investment company can support full-time staff of security analysts and portfolio managers who attempt to achieve superior investment results for their investors. And finally, lower transaction costs. Because they trade large blocks of securities, investment companies can achieve substantial savings on brokerage fees and commissions. Important definitions: we already covered the investment company definition. Now let's look at net asset value definition. Net asset value, or as commonly known as NAV, is basically assets minus liabilities expressed on a per share basis. Its formula is market value of assets minus liabilities divided by shares outstanding. Now let's look at different types of investment companies. In the United States, investment companies are classified by the Investment Company Act of 1940 as either unit investment trusts or managed investment companies. The portfolio of unit investment trusts are essentially fixed and thus are called unmanaged. In contrast, managed companies are so named because securities in their investment portfolios continually are bought and sold. The portfolios are managed. So managed companies are further classified as either closed-end or open-end. Open-end companies are what we commonly call mutual funds. So unit investment trusts are basically pools of money invested in a portfolio that is fixed for the life of the fund. To form a unit investment trust, a sponsor, typically a brokerage firm, buys a portfolio of securities which are deposited into a trust. It then sells to the public shares or units in the trust, and this is called redeemable trust certificates. All income and payments of the principal from the portfolio are paid out by the fund's trustees. which is normally a bank or a trust company. So all the funds are paid to the shareholders. There is little active management of a unit investment trust because once established, the portfolio composition is fixed. Hence, these trusts are referred to as unmanaged, unlike the managed investment companies. The trusts tend to invest in relatively uniform types of assets. For example, one trust may invest in municipal bonds, another in corporate bonds. The uniformity of the portfolio is consistent with the lack of active management. So the trusts provide investors a vehicle to purchase a pool of one particular type of assets, which can be included in an overall portfolio as desired. The lack of active management of the portfolio implies that management fees can be much lower than those of managed funds. Now, for managed investment companies, on the other hand, there are two types of managed companies, as we mentioned: closed-end and open-end. In both cases, the fund's board of directors, which is elected by shareholders, hires a management company to manage the portfolio for an annual fee. That typically ranges from 0.2% to 1.5% of assets. In many cases, the management company is the firm that organized the fund. For example, Fidelity Management and Research Corporation sponsors many Fidelity mutual funds and is responsible for managing the portfolios. It assesses a management fee on each Fidelity fund, and in other cases, mutual fund will hire an outside portfolio manager. For example, Vanguard has hired Wellington Management as the investment advisor for its Wellington fund. Most management companies have contracts to manage several funds. Now, to understand what's an open-end fund, an open-end fund stands ready to redeem or issue shares at their net asset value, although both purchases and redemptions may involve sales charges. When investors in an open-end fund wish to cash out their shares, they sell them back to the fund at net asset value. And in contrast to that, we have closed-end funds. These funds do not redeem or issue shares. Investors in closed-end funds who wish to cash out must sell their shares to other investors. Shares of closed-end funds are traded on organized exchanges and can be purchased through brokers just like other common stock, and their prices therefore can drift away a little bit from net asset valuation. So from these explanations, you could see that the key differences between open-end and closed-end funds boil down to two key factors. The first factor is the shares outstanding. So in a closed-end fund, there is no change unless new stocks are offered, whereas in open-end funds, changes when new shares are sold or old shares are redeemed. And the other key difference is in pricing. In an open-end fund, the shares price always equals the net asset value or NAV, and whereas in the closed-end fund, share price may trade at a premium or discount to NAV. Here you can see a list of closed-end mutual funds, and you can see being closed-end funds, you can see that they often trade at either a premium or a discount to their NAV. So if we look at the first fund at the top, for example, Adams Express Company, ADX, its NAV is 12.89 cents, so $12.89, whereas the current market price for the units of this fund is $11 $13.11. So that means it is currently trading at a discount of 13.81%. And again, the last column is just showing the 52-week return, which is a very commonly used metric to show the return of the mutual fund over the last year period, or the previous 52 weeks, which represent a year. We already covered unit investment trust and managed investment companies, but we also have other investment organizations, because some intermediaries are not formally organized or regulated as investment companies, but nevertheless serve similar functions. So among the more important are commingled funds, real estate investment trusts, and hedge funds. Now, for commingled funds, these are partnerships of investors that pool funds. The management firm that organizes the partnership, for example a bank or insurance company, manages the funds for a specific fee. Typical partners in a commingled fund might be trusts or retirement accounts that have portfolios much larger than those of most individual investors, but are still too small to warrant managing on a separate basis. Real estate investment trusts, on the other hand, or as commonly called REITs, if you've heard of the term before, is similar to a closed-end fund, but REITs invest in real estate or loans secured by real estate. So besides issuing shares, they raise capital by borrowing from banks and issuing bonds or mortgages. Most of them are highly leveraged, with a typical debt ratio of 70%. There are two principal kinds of REITs. Equity trusts invest in real estate directly, whereas mortgage trusts invest primarily in mortgage and construction loans. REITs generally are established by banks, insurance companies, or mortgage companies, which then serve as investment managers to earn a fee. Finally, hedge funds. Hedge funds are a private investment pool open to wealthy or institutional investors that is exempt from SEC regulation and can therefore pursue more speculative policies than mutual funds. Now let us take a closer look at mutual funds. Mutual funds is the common name for an open-end investment company that we've talked about earlier. This is the dominant investment company in the United States today, accounting for about 90% of investment company assets. Assets under management in the United States for mutual fund industry were nearly 12 trillion in early 2011. Roughly another 11 trillion was invested in mutual funds of non-US sponsors. Now, for the investment policies of mutual funds, each mutual fund has a specified investment policy which is described in the fund's prospectus. For example, money market mutual funds hold the short-term, low-risk instruments of the money market, while bond funds hold fixed income securities. Some funds have even more narrowly defined mandates. For example, some bond funds will hold primarily treasury bonds, others primarily mortgage-backed securities. Management companies manage a family or complex of mutual funds. They organize an entire collection of funds and then collect a management fee for operating them. By managing a collection of funds under one umbrella, these companies make it easy for investors to allocate assets across market sectors and to switch assets across funds while still benefiting from centralized record keeping. Some of the most well-known management companies are Fidelity, Vanguard, of course, Putnam and Dreyfus. There's BlackRock, iShares, and what else off the top of my head? uh, Schwab. And now each of these offer an array of open-end mutual funds with different investment policies. In early 2011, there were over 8,000 mutual funds in the United States, which were offered by 669 fund complexes. Some of the more important fund types classified by investment policy are discussed next. So we have money market funds. These funds invest in money market securities such as commercial paper, repurchase agreements, or certificates of deposits. The average maturity of these assets tends to be a bit more than 1 month, and they usually offer check writing features, and net asset value is fixed at $1 per share, so that there are no tax implications such as capital gains or losses associated with redemption of these shares. And then we have equity funds. Equity funds invest primarily in stock, although they may, at the portfolio manager's discretion, also hold fixed income or other types of securities, typically at a fixed percentage of the portfolio size. Equity funds commonly will hold about 5% of total assets in money market securities to provide the liquidity necessary to meet potential redemption of shares. Stock funds are traditionally classified by their emphasis on capital appreciation versus the current income. Thus, income funds tend to hold shares of firms with high dividend yields that provide high current income. Growth funds are willing to forego current income, focusing instead on prospectus for capital gains. While the classification of these funds is couched in terms of income versus capital gains, it is worth noting that in practice the more relevant distinction concerns the level of risk these funds assume. So growth stocks, and therefore growth funds, are typically riskier and respond more dramatically to changes in economic conditions than do income funds. And then we have specialized sector funds. Some equity funds called sector funds, they concentrate on a particular industry. For example, Fidelity markets dozens of select funds, each of which invests in a specific industry, such as biotechnology, utilities, precious metals, or telecommunications. Other funds specialize in securities of particular countries. We also have bond funds, and of course, as the name suggests, these funds specialize in the fixed income sector. Within that sector, however, there is considerable room for further specialization. For example, various funds will concentrate on corporate bonds, treasury bonds, mortgage-backed securities, or municipal, which is the tax-free bonds. Indeed, some municipal bond funds invest only in bonds of a particular state or even a particular city in order to satisfy the investment desires of residents of the state who wish to avoid local as well as federal taxes on the interest income. Many funds also specialized by maturity, ranging from short-term to intermediate to long-term, or by the credit risk of the issuer, ranging from very safe to high yield or even junk bonds. We also have international funds. These can be broken down into multiple groups. So first we have global funds, which invest in securities worldwide, including the United States. We also have international funds, which invest outside of the United States. So you could say these are global funds excluding United States. And then we have regional funds, which focus on particular part of the world. And finally we have emerging market funds, which invest in developing nations. Another type of mutual funds is what is called balanced funds. So these funds are designed to be candidates for an individual's entire investment portfolio. These balanced funds hold both equities and fixed income securities in relatively stable proportions. Life cycle funds are balanced funds in which the asset mix can range from aggressive, primarily marketed to younger investors, to a more conservative, which is directed at older investors. And of course, this structure would basically play on the percentage of equities or the ratio of equities to money market securities or fixed income securities. Static allocation life cycle funds maintain a stable mix across stocks and bonds, while targeted maturity funds gradually become more conservative as the investor ages. Many balanced funds are in fact funds of funds. So these are mutual funds that primarily invest in shares of other mutual funds. Balanced funds of funds invest in equity and bond funds in proportions suited to their investment goals. One example of these funds of funds is something that I personally invest in. It's one of Vanguard's mutual funds. Its ticker symbol is BNDW, which basically holds about 51% of U.S. investment grade bonds and 49% of emerging and developed markets investment grade corporate bonds. We also have asset allocation and flexible funds. These funds are similar to balanced funds in that they hold both stocks and bonds. However, asset allocation funds may dramatically vary the proportions allocated to each market in accordance with the portfolio manager's forecast of the relative performance of each sector. Hence, these funds are engaged in market timing and are not designed to be low-risk investment vehicles. And then finally we have index funds. An index fund tries to match the performance of a broad market index. The fund buys shares in securities included in a particular index in proportion to the securities representation in that index. For example, the Vanguard 500 Index Fund is a mutual fund that replicates or attempts to replicate the composition of the Standard & Poor's 500, the S&P 500 stock price index. Because the S&P 500 is a value-weighted index, the fund buys shares in each S&P 500 company in proportion to the market value of that company's outstanding equity. Investment in an index fund is a low-cost way for small investors to pursue a passive investment strategy. That is, to invest without engaging in security analysis, and nearly 25% of assets investments in equity funds in 2012 were in index funds. Of course, index funds can be tied to non-equity indexes as well. For example, Vanguard offers a bond index fund and a real estate index fund. Only the fund's stated investment policy and past performance, but also its management fees and other expenses. Comparative data on virtually all important aspects of mutual funds are available in the annual reports prepared by CDA Weisenberger or in Morningstar's mutual fund sourcebook, which can be found in many academic and public libraries. So you should be aware of 4 general classes of fees. These classes of fees begin with operating expenses. These are basically costs incurred by mutual fund in operating the portfolio, so including administrative expenses and advisory fees paid to the investment manager. These expenses usually expressed as a percentage of total assets under management and they may range from 0.2% to 2%. So shareholders do not receive an explicit bill for these operating expenses. However, the expenses periodically are deducted from the assets of the fund. We also have what is called a front-end load, and these are basically commissions or sales charge paid when purchasing the shares. And on the other hand, we have back-end load, which is the exit fee incurred when selling the shares of the mutual fund. And finally, the main fee category is 12b-1 charges, and these are annual fees charged by mutual funds to pay for marketing and distribution costs. It is worth noting that the Securities and Exchange Commission allows the managers of so-called 12b-1 funds to use fund assets to pay for distribution costs such as advertising, promotional literature including annual reports and prospectus, and most importantly, commissions paid to brokers who sell the fund to investors. These 12b fees are named after the SEC rule that permits use of these plans, and funds may use annual 12b-1 charges instead of or in addition to front-end loads to generate the fees with which to pay brokers. As with operating expenses, investors are not explicitly billed for 12b charges. Instead, the fees are deducted from the assets of the fund. Therefore, 12b-1 fees, if there's any, must be added to operating expenses to obtain the true annual expense ratio of the fund. The SEC now requires that all funds include in their prospectus a consolidated expense table that summarizes all relevant fees. The 12b-1 fees are limited to 1% of a fund's average net assets per year. You can easily access a comparison for different mutual funds fees through Morningstar's website. It is also worth noting that each investor must choose the best combination of fees. Obviously, pure no-load, no-fee funds distributed directly by the mutual fund group are the cheapest alternative, and these will often make the most sense for knowledgeable investors. But as we noted earlier, many investors are willing to pay for financial advice, and the commissions paid to advisors who sell these funds are the most common form of payment. Alternatively, investors may choose to hire a fee-only financial manager who charges directly for services instead of collecting commissions. Now, these advisors can help investors select portfolios of low or no-load funds, as well as provide other financial advice. Independent financial planners have become increasingly important distribution channels for funds in the recent years. If you do buy a fund through a broker, the choice between paying a load and paying 12b-1 fees will depend primarily on your expected time horizon. Loads are paid only once for each purchase, whereas 12b-1 fees are paid annually. Thus, if you plan to hold your fund for a long time, a one-time load may be preferable to recurring 12b-1 charges. Now, in order to calculate the cost to initially purchase one share of load fund, you can figure that out by adding NAV to the front-end load percentage, if there's any. The stated loads typically range from 0 to 8.5%, and the load is designed to offset expenses of marketing the fund, and it goes to broker who sells the fund to investors. If you have an effective load greater than the stated load, then you need to be aware of that. Now, the rate of return on an investment in a mutual fund is measured as the increase or decrease in net asset value plus income distributions such as dividends or distributions of capital gains expressed as a fraction of net asset value at the beginning of the investment period. So if we denote the net asset value at the start and end of the period as NAV0 and NAV1 respectively, then we can calculate the rate of return by using the following formula: NAV1 or net asset value at the end of the period minus net asset value at the beginning of the period plus income, which is represented by any distributions or dividends received during the period, plus capital gains distribution, which is basically any increase or change in the value of the unit or the assets, divided by net asset value at the beginning of the period. This should give us the rate of return at the of the investment. For example, if a fund has an initial net asset value of $20 at the start of the month and makes income distributions of 15 cents and capital gain distributions of 5 cents and ends the month with NAV of 20.10, so $20.10, the monthly rate of return is computed as 20.10 minus 20 plus 15 cents plus 5 cents divided by 20. This will give us 0.015 or 1.5%. Here is a hypothetical comparison between different kinds of funds when it comes to their fee structures. So notice here we have a different time horizon with an initial investment of $10,000 or approximately $10,000, and we have 5-year and 10-year, 15-year and 20-year reassessment periods. We here assuming that Fund A is a no-load fund with a 0.5% expense ratio, and Fund B is a no-load with 1.5% total expense ratio, and Fund C has an 8% load on purchases and a 1% expense ratio. Now we also assuming that the gross return on all of these funds is 12% per year before expenses. Now notice how the different performances of these funds, and you be the judge of the comparison and on which kind of fund structure or fee structure is more suitable for you, of course depending on your investment horizon. Here's a set of general tax rules that dictate the mutual fund investments. So first consideration, the fund itself is not taxed if diversified and income distributed to the investors. So only the investor is liable to pay taxes on their investments, and the fund itself does not pay taxes. The investor is taxed on both capital gain and dividend distributions, and the turnover of the fund is really important in tax considerations. The turnover is basically the ratio of trading activity to assets of the portfolio, so how often the fund is buying and selling shares. The portfolio turnover may affect the investor's tax liability because a higher turnover constitutes a relatively higher tax obligation. Another implication of having a high fund turnover is that the fund would pay commissions or commission costs on portfolio purchases and sales, and these commissions are directly charged against the net asset value. So it does cost the investor more to invest in a mutual fund with a higher turnover. So it is also a good consideration or good practice to look at the turnover ratio of the mutual fund that you plan to invest in before investing, and if you have an alternative with a lower turnover ratio, that would be the preferred alternative. The turnover rate is measured as an annual total asset value bought or sold in a year divided by average total asset value. This is basically how you calculate the turnover ratio. Now we move on to talk about exchange traded funds, or ETFs. These are offshoots of mutual funds. They were first introduced in 1993, and they allowed investors to trade index portfolios just as they do shares of stocks. The first ETF that was introduced was the SPDR, which is a nickname for SPDR, or Standard & Poor's Depository Receipt, which is a unit investment trust holding a portfolio matching the S&P 500 index. Now, unlike mutual funds, which can be bought or sold only at the end of the day when NAV is calculated, investors could trade SPDRs throughout the day, just like any other share of stock. SPDRs gave rise to many similar products, such as diamonds, based on the Dow Jones Industrial Average, ticker DIA, cubes, basically pronounced cubes, based on the Nasdaq 100 index, ticker QQQ, and WIBs, which is the World Equity Benchmark Shares, which are shares in portfolios of foreign stock market indices. Now, ETFs offer a variety of potential advantages. These include trading continuously throughout the day, or the ability to be traded continuously over the trading day. They can be sold or purchased on margin, unlike mutual funds. They offer potentially lower tax rates, and they also offer lower costs because there's no marketing and lower fund expenses. So these are some of the advantages that are offered by the introduction of ETFs, which for a retail investor, in my opinion, is a much viable option for investing and for diversifying investments, especially for passive investors. Another potential advantage that is not in your textbook is that many mutual funds require an initial investment amount. So whether that is let's say $1,000 or $3,000, $10,000, but for ETFs there's no minimum initial requirement. As long as you have enough money to buy one share, and for some through some brokers also they offer fractional shares, so you can even buy a part of the ETF, then you can invest in that. So there's no minimum requirements when it comes to the initial investments. Now, in contrast with the advantages that we've just discussed for ETFs, there are some disadvantages to investing in ETFs. First, while mutual funds can be bought for NAV with no expense from no-load funds, ETFs must be purchased from brokers for a fee, most likely. So investors also incur a bid and ask spread when purchasing an ETF. In addition, because ETFs trade as securities, their prices can depart from NAV, at least for the short period, and these prices discrepancies can easily swamp the cost advantage that the ETFs otherwise offer. Now, when it comes to mutual fund investment performance, I leave it up to you to read up on this topic from your textbook and research this online. But it is worth noting that on average, mutual fund performance is less than broad market performance, especially for specialized mutual fund performances. And the evidence suggests that some persistence in positive performance over certain horizons, but over the long run, the mutual fund performance is or fails to outperform benchmarks. The last point I want to cover for today is how we as retail investors can get access to information on mutual funds. The sources of information on mutual funds are multiple, and the main ones listed here include Morningstar, which is a very famous website that rates different funds and gives them a risk rating and return rating out of 5 stars, and it is a great resource to research different mutual funds and compare them against each other. And of course, you also have the ability to access the prospectus of the fund that you plan to invest in, so you can read about the benchmark of the fund and the investment goals and the assets under management, the top holdings, the past performance of the fund, and all of these information you can see or you can find in the fund's prospectus. You also have Yahoo Finance website, the Wall Street Journal, and also Investment Company Institute, ICI, American Institute of Individual Investors, and finally the broker itself that you are investing through. So if you look at examples such as TD Ameritrade, they do have information. They would have the fund prospectus available on their brokerage website, and they will also have their own analysis and breakdown of the fund and show you its performance and show you comparisons to other mutual funds. And in the end of this lecture, I would like to thank you all for listening, and now I'd be glad to answer any questions that you might have about today's lecture. Thank you.